Hello and welcome. Today, we are cracking open one of the most useful accounting standards out there, IFRS 8. This is the rule that gives us, a sort of X-ray vision to see what's really going on inside the world's biggest and most complex companies.
So just think about it for a second. You've got one of these giant conglomerates. One division is building jet engines, another is all about medical devices, and then they've got a third arm in streaming services. If all you see is one big profit number at the end of the year, are you really getting the full story? I mean, how can you tell which part is flying high and which one is dragging the whole thing down?
And that's exactly the problem, right? To really get a handle on a company like that, you can't just look at the final consolidated numbers. You've got to break it down. We need to see how each of those individual business units is performing to truly understand the health and, frankly, the strategy of the entire organization.
And this is precisely where IFRS 8 comes into play. Its whole reason for being is to force that transparency. The core principle, and we're taking this straight from the source, is all about letting people like us, the ones reading the financial statements, see all the moving parts and really evaluate what the company does and how it makes its money. Okay, so how does IFRS 8 actually decide which pieces of a company we get to see? Well, it all starts with this concept called an operating segment. And the big idea here, the really key insight, is that IFRS 8 wants us to see the company through the same lens that its own top management uses. Now, you can't just call any old department an operating segment. The standard is super specific. For a piece of the business to officially earn that title, it has to pass a very clear three-part test. And here they are. First, it's got to be an actual business. It earns its own revenues and has its own expenses. Second, and this one is absolutely critical, its results have to be on the desk of the top decision makers who are looking at it all the time to make calls. And third, you need to have separate financial data for it. If you can check all three of those boxes for a part of a company, bingo, you've got yourself an operating segment. Now, the standard throws this term at you, the Chief Operating Decision Maker, or CODM for short. But don't let the formal title fool you. The rule makes it very clear this isn't about a specific job title. It's about a function. It could be the CEO, sure, but it could also be the Chief Operating Officer or even a whole executive committee. The important thing is, this is the person or group that looks at the numbers and decides, hey, should we give this division more money or should we scale it back? They're the ones holding the purse strings. All right, so the company has looked internally and figured out all its different operating segments. But does it have to report every single one of them in its annual report? Well, not necessarily. This brings us to the next step, figuring out which ones are actually big enough or significant enough to be disclosed to the public. So to make the cut, an operating segment has to clear at least one of three different quantitative hurdles. We usually just call them the 10% tests. Think of them like a set of filters. If a segment is large enough to pass through any single one of these filters, it automatically becomes a reportable segment. The first filter is all about revenue. It's pretty straightforward. You look at a segment's total revenue, and that includes money from outside customers and sales it makes to other segments inside the company. If that number is 10% or more of the combined revenue of all the segments put together, then it has to be reported. Okay, the second filter is the profit or loss test. And this one's a little trickier, but it's actually really clever. First, you add up the profits of all the segments that made money. Then you separately add up the losses of all the segments that lost money. You look at those two totals, the total profit and the total loss, and you pick whichever one is bigger. If an individual segment's profit or loss is more than 10% of that bigger number, it's reportable. This is so smart because it catches segments that are either huge profit engines or, significant drains on the company's resources. And the final 10% test is the asset test. Simply put, are this segment's assets 10% or more of the total assets of all operating segments combined? This one helps catch those really capital-intensive parts of the business that might be a huge part of the company's foundation, even if their revenue or profit isn't as high. But wait, we're not quite done. After a company has identified all the segments that passed at least one of those 10% tests, there is one more final check. We have to make sure that what's being reported actually represents the bulk of the company's business. And this is where the 75% rule comes in. This rule is basically a safety net. You take all the segments you've identified as reportable and you add up their revenue from external customers only. That total has to be at least 75% of the entire company's total revenue. If it's not, the company has to go back and start designating more segments as reportable, even smaller ones, until they hit that 75% threshold.
This is so important because it stops companies from hiding a big chunk of their operations in some vague all other category.
So, we've identified the reportable segments. Now for the fun part. What information does the company actually have to show us for each one? This is where IFRS 8 really delivers the goods for anyone trying to analyze a company.
The standard requires a pretty detailed breakdown. For each segment, the company has to show us a measure of its profit or loss and its total assets. They've got to split out revenues between external customers and those internal transfers. And on top of that, they have to give us details on key items like interest, depreciation, and any other really significant income or expense items. You're basically getting a mini financial statement for every major part of the business. It's awesome. Now for the final piece of the puzzle, and you could argue it's the most important. All of these individual segment numbers have to tie back perfectly to the company's main financial statements. This is the step that makes sure nothing gets lost or hidden between the parts and the whole. And they do this through something called a reconciliation. You can see in this example, the company lays it all out. They start with the profits from each reportable segment, add in the profit from the smaller segments that are lumped together, and then they account for any reconciling items. Things like corporate overhead that don't belong to any single segment. And at the end of the day, that number has to exactly match the total profit you see on the main income statement. Everything has to add up, no exceptions. So there you have it. IFRS 8 is the rule that pulls back the curtain. It forces big companies to show us the different engines that are powering their performance. It lets us look past the big headline numbers and really understand the strengths, the weaknesses, and the dynamics playing out inside. So I'll leave you with this question. Now that you know what to look for, which company's annual report are you going to go read with a totally new set of eyes?